Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website at commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any specific trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. And today is February 17th. Good morning, Andy.
Good morning, Jim.
I was looking at the EIA's monthly short-term energy outlook, and my favorite chart in there is their notable changes. These are revisions from their previous month, and it showed that natural gas prices for 2023 were lowered by 30.5%, and this is in 1 month period. And the jet fuel margins were revised up by 18.7%. And we have a tremendous amount of respect for the analysts at the EIA. And I bring this up only to kind of underline what we've been talking about for a while now, and that's how difficult it is to get your hands around these markets. So I'd like to start off talking about the big three short-term energy outlooks that we focus on: the OPEC, EIA, that's the U.S.'s Department of Energy's analyst stats arm, and the IEA. And when I look at the demand they show for 2023, OPEC is at plus 2.3 million barrels a day. The IEA is plus 2.0 million barrels a day, and the EIA is plus 1.1. So that's a huge diversity in just on the demand side. And why don't you comment on that?
Well, Jim, I think we should also add the maybe not the big four, maybe a mid-major four, the CRG balance sheet
Yeah,
as well. I guess we're not blue bloods, but we also do our balances, and I think, as our listeners know, our balances tend to be a little bit closer to where the closer to being correct. I mean, for
yes, y-
to be blunt.
yes,
But and what we're looking for on the demand side is somewhere in the middle. We have up 1.55 on million barrels per day on demand, which you know what, I feel pretty good about. The EIA's number, they're looking for, I think, more of a slowdown in the first half economically. I think they have negative growth for the first half of the year, at least in the U.S. So I think that their economic outlook is influencing their demand outlook. On OPEC, and well, OPEC, they're in one way they're talking their book, showing that big of a demand increase. That's going to be good for OPEC. But I think that's 2.3 would really mean that the economy is humming, the global economy is humming along, and China has come back in a big way, which also is what the IEA is talking about. I think the IEA has China up. I think it's close to a million barrels a day. We're like 0.7 on China, but is a million barrels a day possible? Yeah, yeah, sure. If they can crank it up in the second half, and that's based really on jet fuel, with the theory being that China savings rates have been pretty high during COVID, and now they're ready to spend and travel, similar to what we saw in the West after COVID was deemed just about over. As far as diesel is concerned, probably less of an increase because the thinking there is manufacturing is going to come on later, and we'll probably see more of more travel, and that's going to be the big driver. And the IEA, they made a big move. I mean, they made a big correction. They were looking at in their last monthly, or maybe it was in November monthly, they were up 1.6. So they added 400,000 barrels a day to their demand estimates, and that's a big hike, and it was probably all on China.
Yeah, I'm looking at their jet fuel number. They're looking at plus 1.1 million barrels a day, up to 7.2, and they're saying that's 90% what they had for 2019. So that's a kind of odd to see a jet fuel being, you know, front and center in terms of what's one a sharp demand driver there. But can you? I guess so. It seems that people are these three groups are looking for the second half of the year for demand to start rocking and rolling a little more, and I don't see it. I don't see it in the. We continue to see some of those $1 strike call spreads trading, not as actively as we did, say, in 2022. And there's still some that are left on. Maybe I'll get into more details later. But are you seeing any people putting on trades for like? Is it showing up in the crude curve or anything like that? That the
Well,
sort of the second half of the
the
years.
The crude curve, not really. I mean, the crude curve, yeah, it was, at least on the Brent side, pretty well back. It's the backwardation on Brent and in WTI really steepened in January. But now, as we move into February with these monster crude builds, the backwardation is definitely is softening a lot in both curves. So I think that, yeah, there was expectations for second half. You look at the big rally, let's say, and just Red Dece. We'll take a vanilla one. December 23 versus December 24 really rallied significantly in January, and as I said, it's come off now. So I think that given what's happened on the commercial crude on the U.S. crude inventory side, that trade is being reevaluated, seriously being reevaluated.
Well, I mean, this is a good time to talk about the weekly balance numbers that came out showing a 16.3 million barrel build in U.S. crude oil stocks. That's a pretty hefty number.
That was a really surprising number, to say the least. The big number there, and this is important, was their balancing number. I think it was something. It was over 2 billion barrels a day to balance. What the EIA does is, if all the variables like crude runs and imports and exports, SPR releases, if they don't add up to what the crude stock number is, then they will put in a number to balance. And last week it was monster. But the thing is that what's probably correct is the crude stock number.
Right.
And I think the market was very cavalier when the number came out. They said, "Oh, it's just the balancing number. It doesn't mean anything." But it
Yeah.
means everything, because it just means that the production or the imports or the exports or the crude run numbers, those were wrong. What's probably right is the stock number. So we did build 16 million. And I think some of the sell-off here that we've seen later this week, Thursday and Friday, and particularly today, Friday, February 17th, is part and parcel of that big build. I mean, at the end of November, U.S. crude stocks were 426 million barrels. They're now 471
Mhm.
million barrels. So we've built almost a million barrels a day here over the last 3 months. And if you look at US crude stocks, we're in surplus.
Mm.
We're at 471 million barrels. The 2015 to 2019 average, which is pre-COVID, and it's what we like to use for somewhat normal numbers, was 446, and in terms of days supply, we're running like 3.5 days over that average. And yeah, I think we're at, if you look at where we're at, we're in good shape now. Stocks will draw as runs increase, but it doesn't look like there's going to be any near term shortfall whatsoever on the crude stocks,
That's
on U.S. crude stocks, except for we're going to draw when runs increase in April, May, in second quarter.
right. So what I was going to say is, it looks like we built stocks maybe a little early for the seasonality, and we still have to go into the turnarounds. I mean, runs are
Right.
going to go down going forward, right, for the next few weeks.
Yeah, next few weeks runs are gonna, right, the 4-week average is like 15.1, let's say 15. They'll go down. Yeah, not a lot. I mean, we're already down because we had all the refinery issues from the Christmas freeze out in the Midwest and the Gulf Coast. So that's a big reason why we've built so much, is those refineries. Some of them didn't come back, and plus there were other refinery problems in the Northwest, California, Upper Midwest. So
Rockies. Yeah.
Rockies, right? We've had refinery issues galore. So we were nowhere near where we should have been on crude runs in January and February.
So do you think that shortens the or just moves the turnaround season back a little bit? So uh, typically they start coming back in March and April. Maybe they come back a little earlier this year. Do you think that's possible, that we're just seeing these builds in crude a little early than normal, and it's not that and we're going to see the refineries come back earlier than normal as well, or
Yeah,
no?
it's possible. It depends on some of these refineries that didn't come back, how much work they did while they were down. One big problem with turnarounds is trying to schedule crews to come in and
Uh,
the maintenance crews to come in. But yeah, I think that's possible that we do see, crude runs inch up a little, maybe a little bit faster in March and April. That they should peak in May and June, assuming everybody comes back. They should be like May and June should be. We're at 15 now. Say May and June, we should be pushing 17.
mm,
And then we should be drawing. We should be drawing stocks, but the key is we're drawing stocks from a pretty high level.
right. So we talked about this off the air before we get on. It was the possibility of the market breaking down. We've been in kind of a trading range for a while now, and it's kind of the scenario nobody's looking at, you know, right?
Oh yeah, I think that there's been so much bullish sentiment by just about everybody. Particularly the banks have really been banging the drum for much higher prices. I noticed that most of them are now lowering their estimates, rightly so. But I think you're right, Jim. The one thing I think if it broke down through 70, that would really blow a lot of people's minds and their trading positions too, because, the market's definitely leaning long.
Yes, no question about that. So that's I was thinking the other scenario that doesn't seem to be getting much play is what happens if we have like solid growth and inflation coming down. So we had some bad PPI number yesterday, but it's one number. You know what happens? People talking about a soft landing, hard landing. inflation longer, higher. But what if we have a Goldilocks moment where we get to 2.5% growth and a trend of inflation coming down? I don't think that's in the cards, but I don't think it's in the chat that I listen to or read on in the news. But the Atlanta nowcast GDP nowcast is for this quarter, first quarter, is at 2.5%, which is, you know, basically the numbers are quite good so far, and that's the U.S. So yeah, we'll see what happens. If always like to look at those least talked about scenarios because those are oftentimes the way to trade this market. It's a way to kind of, if you can make a case for it and nobody's doing it, it's got it. You start thinking about it more and say, okay, let's look. This is a possibility. So
Yeah,
maybe
I think if that scenario comes in, then OPEC is going to be closer to the pin on their on their demand estimate, OPEC and the IEA,
so.
because
Would
that'll crank out, that'll be that'll be, those we should see some decent demand numbers at that point.
you would think if OPEC's looking at plus 2.3, and again that's the monthly report that bunch of excellent analysts put out. It doesn't mean that the OPEC members have their internal numbers the same, but let's say that they agree that growth is going to be plus 2.3. You think that makes them more likely to increase barrels into the market, or
No,
they sit back and wait?
I think they sit back and wait and take the price. The Saudi minister basically said the other day that he thought that the agreement, their last agreement, was good for the year, that they weren't going to make any, any changes. And I think most analysts, are looking at it. I know I am just looking at OPEC production is pretty steady. The number I put in pencil, but maybe I'll put it in more in pen. Is an OPEC production of around 29 million barrels a day, give or take. And, I think that's the number, give or take a couple of 100,000 barrels a day either way. And then, I think that's a number most everybody's plugged into their balances.
See,
If things, I think if prices, yeah, I guess if prices got into the tail that the tail regions you were
yep,
talking about, Jim.
yes.
Yeah, they would reconsider. If the market really broke down, they might reconsider. I mean, I'm sure they're not happy that Russia just announced the 500,000 barrel a day cut, and the market basically went up a little, and then has gone
It's
down.
below that number, yeah. So why don't
Yeah.
we talk about that? What do you think? How are you reading that 500,000 barrel cut in production by Russia?
Well, you could either look at it. I think there's certainly ways to look at it. Being a inveterate barrel counter, I look at it, not that I discount the political, which I'm sure is a key, maybe a key element because they could use that for any propaganda that they might want to, and indeed they did after the announcement, saying they're gonna, this is to punish the West for the price cap and blah blah blah. But commercially, they just may have problems moving either crude or diesel. And there's been reports that they don't have the ships to move some of the barrels. The whether or not the markets are going to could take more or less, or take the same amount of crude, unless it's heavily discounted, is another factor. And as I think we spoke about last month, there's the diesel factor. Where are you going to move your diesel? year they averaged to the there's now an embargo on EU products, on Russian products to the EU, a full embargo. So, their main product, the most important product is diesel. Last year they exported like, let's call it 650, 700,000 barrels a day of diesel to the EU, and in January to the UK. They really cranked it up though in December and January. They were up like 1 million barrels a day of exports uh, before the embargo. So even using 750, they have found some. It looks like they found some markets in the Middle East. To export to the Middle East and Africa, North Africa, and for the Middle East refiners, they may be able to rebrand that the Russian diesel, rebrand it as non-Russian diesel, and export it back to Europe, which is kind of ironic to say the least. And they're moving to Africa. Whether or not they're going to replace all of it is unclear. The market's waiting. That's a wait and see, and whether they have the ships to replace it. And if they don't replace it, then you're looking at possible crude run cuts. So so that 500,000, some of it may be commercial, and they use it for political. They're using it politically. Interestingly, last in the fourth quarter, Novak, the Russian oil minister, said that he thought that 2023 Russian oil production would be down from 500 to 700,000 barrels a day, and that's sort of the number we're using, Jim. I have in my own little barrel counting machine. I put Russian production down like 650. Others are more. Others are like over 1 million barrels a day. Like the IEA is, I think, over 1 million barrels a day. I think the EIA is Russian production going down.
Huh.
So obviously there's a lot going on the flow side, and
Yeah.
traders are carefully watching what's going on.
It's interesting. I guess from last year, IEA originally saw 3 million barrels a day of Russian oil shut in. I'm pulling this off a news
Right.
article I saw, and now instead they use the word some. Some oil will be shut in. So yeah, again, that's another difficult numbers to get around. We'll have to see how this sorts out. I did also read that some Russian oil got processed in China, and the diesel that came out of it ended up in the U.S. So I don't know if that's true or not, but it shows you the complex trade routes that are getting disrupted and changed, and you know because of the embargoes.
Yeah, they're definitely they've been able to export fuel oil to Asia, maybe China, and it's being upgraded and into a lighter product. And it's certainly possible. You look at all the Russian oil that India's been taking. No question, some of the products that they've been exporting to Europe has has the products the rush the products as a result of that embargo crude, is ending up in the EU.
And that was the intention of the price ceiling as well, is not
Right.
is to keep barrels on the market. Don't disrupt oil markets as you know price wise, and yet have Russia sell their oil and products at deep discounts. And is that happening?
Yeah, it worked amazingly. A lot of almost everybody was going, this is unworkable, this is crazy, there shouldn't be any price cap. But yeah, so far I think you have to give credit to the architects of that, because it's working.
And let's talk about diesel. When you look at the U.S. stocks, we see gasoline has moved forward, or that stocks have built. Diesel still even though it looks like a slight build, it still looks like it's closer to the 5-year average low as opposed to the 5-year average high for crude and gasoline. Are we still in a shortage here or a tightness or the cracks have come off, but they're
Yeah, the
still high?
cracks have right, the cracks have really come off, and, thanks to the non-winter that we've had,
Yeah.
we had talked about we had talked about a possible shortage in New England and the Middle Atlantic states, and that's not gonna happen now. Even if we have a freezing freezing March and April, we're through the worst of it, and, I think that you're right though, Jim. The distillate stocks are still are still low. I mean, they're still relative to 5-year averages. They're low, and day supply they're like 6 or 7 days days low. The one thing that isn't low though, if you look at Atlantic Basin stocks and you throw in Europe, because of the perceived the loss of Russian diesel, and it's a big hit. Obviously, prices rallied significantly, and everybody sent diesel, including the Russians. Everyone sent diesel to Europe, and so Europe is now in pretty good shape on diesel. And what it's going to mean is if we do have a big, US rally, the Europe ironically is could be sending some excess over to the US. It's not over yet. We're going to planting season, so diesel, I think, out of crude gasoline, where diesel is definitely the one to watch for any bullish notes. Certainly, if the economy remains, the economy was hot in January and probably a little hot in February, but if it remains hot, that'll help on the demand side. The demand is disappointing, I'd say. Not as bad as gasoline, but, still it's running like 3.63 million barrels a day the last 4 weeks. Average is probably like 3.75, 3.8, something like that. Last year, the EIA is also looking for diesel to be like unchanged this year on demand. Same with gasoline. I think they may be too high on gasoline. I mean, gasoline demand is a big, that's a big fact. U.S. gasoline demand is a big factor.
Let's talk about that. What's it what are you thinking for 2023?
I'm thinking that the EIA we may end up behind last year on gasoline. You're seeing like miles driven and demand begin to decouple. They used to be in lockstep, and now they're decoupling. And I think there is certainly, just right now, the 4-week average for gasoline, we're out of season, obviously, but it's 8.3. If you go back to that 2015, 2019 average that I described, it's 9.05. So you've lost 800,000 barrels a day of gasoline demand since the peak years. I think those are going to be the peak years, Jim. I think gasoline demand has probably peaked in the U.S. There's a lot of factors. Obviously, the work from home is a big factor, and what's going to be the biggest factor going forward over the next 5 to 10 years is going to be EVs, and I think we're seeing it in these numbers. I think the EV adoption is probably leading to, 100 to 200,000 barrels a day lost demand so far on gasoline. Maybe more, maybe somewhat less, but that's not stopping. That trend
No,
is not stopping.
no, I bought a hybrid. I love it, and it's not an EV, but it's definitely the gas mileage. I don't have to fill up as much as I notice it. I notice I don't have to fill up. I mean, I obviously I'm talking about driving around. town, yeah, it's unbelievable how much fewer trips I make to the gas station now. But yeah, and is this? I'm not sure this is the first time you mentioned EVs sort of uh, en- e- entering your calculation on gasoline demand. I think for a while you said it was their, you could see their sales were increasing by a lot, but it wasn't a big factor in demand. But now you're saying it is.
Yeah, I was saying it over the last few years because it wasn't.
It wasn't.
You
No.
know, now, 2022 and what we're looking at for 2023, it is. So I am putting it in there, and and each year EV sales are going to increase. There's more competition. Besides Tesla, that was the other thing. I mean, it was basically Tesla or nothing. And as we go forward, it's going to be a bigger and bigger portion, not only here in the US, but it's already a big percentage in China.
Yes.
And we know Norway is a big is a big percentage, not a big user, but
Yeah.
and government is it's right
Fleets are going
there.
that way. Yep. Yep.
Yeah,
Yeah.
it's going that way.
Not sure I would
So
want to do it if I was in Minnesota when it was what, minus 30 degrees.
right.
Yeah. But yeah, I think we're seeing it in the numbers, and they are having an effect for sure.
Yeah, you can't ignore it. It can't be ignored anymore. Besides the economic and the work from home. I think EV is now a factor.
So if let's say that demand doesn't come back in gasoline for refiners, how much tweaking can will they tweak to make, run diesel like it was wintertime and not, not a summer driving season, or is it not quite there yet? You know what I'm saying? Is it will
I
they
don't think it's yeah. I mean, I don't think it's there yet. I mean, they could tweak as best they're able, depending on the type of crude they run, and what they can do with feedstocks, et cetera, to make more diesel. The key is that what is going to happen is the for gasoline is just going to become more and more of an export market.
Mhm.
And U.S. refiners are going to have to look for growth, whether it's South America or it'll probably be, there'll be more exports to South America, and we're gonna be competing globally for growing, where gasoline is growing, and probably that competition is going to put some pressure on margins. Not yet, but as we go forward,
Mhm.
gasoline's going to be the product that is going to be, as I said, probably the most competitive. Diesel still should be diesel and jet. Ultimately diesel too, but not right. Not right this second because of trucking and rail. But so it's going to be a challenge for U.S. refiners, particularly since the new refinery capacity that's coming on is you know the, they're modern refiners. They're modern refineries
Yeah.
coming on in Asia,
Right.
and we'll see if that Nigerian when and if there's a 600,000 barrel a day refinery ready to go in Nigeria, but it hasn't quite opened yet. So we'll be watching.
Yeah.
That
Interesting.
that's another that'll be competition for the Asian and European refiners.
Uh, I want to get a couple questions in before we get to the prices. But the SPR is releasing another 26 million barrels. I think the SPR is at the lowest amount of oil since 1983. Do you see that as an issue?
It's become a political issue.
I know.
Uh, I
Everything's
don't
a
I don't
political issue.
commercially, no, I don't think it's a big issue, and this was already approved. This isn't part of the emergency release.
right.
So, this is just to use for I think Congress wanted just to help balance the budget. So, no, I don't. I mean, it's not a lot. It's 300,000 barrels a day.
Maybe
So
if they wanted to balance the budget, they should be trading the curve.
they should be, of course, they should be trading the curve. But
It's like a bunch
you,
of layups over the years.
oh my God, but
But
Jim,
yeah,
find me the politician who's going to recommend that.
right. I don't know if you remember, but I did a talk in the 80s to the oil producing states on how to use options to hedge, you know, their the revenues for their budget. And it was really interesting because I did get that comment afterward. They said, "Who do you think was going to step out and say, let's hedge some barrels?" And nobody's going to do that. So Alaska might have actually done a pilot program. One of them did a pilot program, but I'm not
Well,
sure.
I spoke to Alaska also in the 80s
Yeah,
about the very same thing.
yeah,
And after my they had a couple of guys talking about it. And after the talk was over, we repaired to the local restaurant, and the governor happened to be there. And he put his arm around me and he goes, "That was very, very interesting, Andrew. I doubt we'll ever do something like that, but that was interesting."
So I think I was in a place called I did my talk somewhere in Colorado. I think it was like Parachute. Is that a it's my memory may fail me, but we went on a tour to a Unocal project in the Rockies to extract oil from the shale rock. And so this would have been 19, maybe was it 87, 88, something like that. I think it might have been 88. And they were telling me that they're about to shut it down because we don't need it anymore. So
Phew.
yeah, yeah. At times, as we get into these cycles, we talk about, the other one I want to ask you, Andy, before I ask you about prices, is that the pounding that we've been hearing for a long time now is that oil companies are not investing in producing oil as much as they used to. They're being disciplined, and and maybe they're just talking about the U.S. shale guys, that seems to be the case. But when you look at non-OPEC production, it's coming on pretty good, don't you think?
Yeah,
Like
it
around the
is.
world,
Yeah, there's going to be decent growth this year in Canada, Guyana will probably be up like 150 to 200,000 a day. Norway is has been a remarkable success story for North Sea production. U.S. Not so, U.S. The production, the growth has really been in non-crude liquids. NGLs last year I think were up like 500,000 barrels a day. They're going to be up a little less this year. Brazil too is bringing is bringing some new production to the market. So yeah, non-OPEC production is growing nicely. Russia, of course, is a non-OPEC producer, so non-OPEC production, would be up, I don't know, a million and a half to 2 million barrels a day, something like that, if it weren't for the loss of Russian. So
Russia,
you're
right?
definitely seeing some growth in non-OPEC production, but the ones that are really and there's investment going. I mean, BP just made a big announcement on their capital expenditures. So they're going to spend more on fossil fuel development than they had planned.
Right.
Uh, but OPEC, the Persian Gulf producers are still, they're still investing very heavily, and you know what? They know even as non-OPEC production grows, it is true. The last few years, the investments, the capital investments by non-OPEC producers, are not, particularly in the U.S., is probably not sufficient to maintain the growth we're going to need at least for the next, I don't know, the next 5 to 10 years. So OPEC's going to be in a very good place.
So story we've been hearing for years now that we're not, maybe a few years now, but that we're not investing enough is still valid out there. That's what
I
you're
think
saying.
it's still, yeah,
Yeah.
I think we could probably invest more. You're kind of caught in the transition here,
Right.
for some of these, for the majors and, the independent producers. So it's good, the next, yeah, you're caught in the transition.
Yep. Prices. You had some good calls the last few months about trading range markets. Let's talk about crude oil first of all. What do you think going forward? Say a month out. What are we
I
doing?
think, I think still a range, but as we've been talking through this call, I guess there's some threat. You'd think beforehand there was no threat for the downside. I think there's a threat 70. We've been in this 75, 85 or 72, 82 type range for a while and longer 70, 90. Could it break 70? Yeah, I guess. Uh, I guess there's a chance. I mean, I like the range a little better because global inventories still are on the low side.
Hmm.
And we are still looking ahead at second half being more of a draw than we're looking for draws in the second half. So I sort of think it's going to hold and still be in this range and and I think we're stuck here, but I think that it's interesting, Jim, that you've brought out, how the downside could be at risk.
Okay, Andy. Anything else you want to talk about before we shut down here
Um,
for another month?
no, I think we covered a lot, Jim.
We did.
We
We
didn't.
did.
I guess I'm going to ask you if you had a option play, what would it be?
Well, I'm in the cocoa market, Andy. So no. uh,
No, WTI.
well, that's a good question. The you kind of when you talk about a trading range market, you thinking about selling straddle strangles. You think about selling options, and that's actually not been a bad play because the implied volatility has been at a like about a 10-point premium over what we measure as historical volatility. They're not perfect measures with each other. One's looking backwards, one's looking forwards. The other, one of them is based on settlement prices, so it doesn't pick up all the volatility. But so basically, the trading ranges have gotten narrow, basically not to support the implied volatility out there. So for the last, I'd say, couple months, the option sellers have had the advantage. But you know, the big question is there's a lot out there that we have this war going on in Ukraine. You can't forget about that. So you have to be careful when you're selling options in this market. So I like to look for markets that are have the volatility squeezed out of them, and it's hard. They're not always there, and to play a direction. So basically, if I'm looking at April, the implied volatility is at 36%, and that's come down from around 50s in last October. So the volatility is getting squeezed. It's probably not such a bad. It still has a premium over the historical, but it's probably not such a bad time to look at buying some out of the money puts or something like that. Um, if I had to do something on crude right now, that's what I would look at.
Certainly not the popular trade.
No, no, that's right. And the as you know very well, analyzing markets and trying to figure out where they're going is different from trading markets, right? You're looking for what's in the market, what's not in the market, and I think what my point today was what I don't think is in the market is the possibility of this going south, and I would think it would be sooner than later. So it's probably, over the next couple of months, not maybe in the back month. So yeah, it's a different game when you're trying to put on positions than just trying to figure out where the market's going, right?
Right.
Yeah,
Oh yeah.
it's like picking the Super Bowl. You had to who ended up being favored at the end? I think it was the Eagles. So that was a good that was a that was a reasonable line. I mean, going into the game, I thought, I didn't have a good idea who was going to win, and the line was like a point and a half, and it flipped from the beginning to the end from one team to the other. So yeah, so I think this market, going back to where we are, does have, like, when I'm looking at options, I think it has a significant bullish bias into it. Um, so yeah, try to play it the other way. So let's. Anything else, Andy? We're good, right?
No, my just if you want to get a hold of me,
Yeah.
I'm at Lebow at commodityresearchgroup.com. Check out our website as well, Commodity Research Group.
Yep. And I am on. You can get me at Commodity Research Group as well, but I'm also on LinkedIn, and I occasionally put up things that I'm interested in markets, not always oil markets, but and I've got a bunch of people, mostly my friends, on there as well. But I I say yes to anybody that wants to connect with me on LinkedIn. And Andy, I'll talk to you next month.
Okay, thanks, Jim.